on the 29th of December 2018. This week in economics, a production that we do roughly 52 times a year, and this will be the last one for 2018 from WBRN Radio and on the Bostonred Network. We look at the national picture and the global picture as far as macroeconomics is concerned. It has changed over the years. If you look at what the Fed now considers in their various surveys, and we'll be looking incidentally at one of those surveys. In this broadcast, we'll look at the Conference Board, a pro-business board, a little different from the people at the University of Michigan and their consumer index. We'll get it. We're, of course, winding down Q4, the fourth quarter of the year. And then we'll start with Q1 of 2019. Now, first quarters are generally, over the long haul, transitional quarters and finishing up the previous fourth quarter. And we'll have some indication of how it is going along. Now, the holiday shopping spree, the holiday season had mixed results. And depending on how it was reported, some indicators are that shopping, at least the online shopping, was up. The average spent by people was more. Well, then we look at it, not in macroeconomics, but in micro, we look at basically what were they buying. And what the impact, in other words, if the gifts or whatever were larger gifts, they'd be buying less. If they were smaller gifts, perhaps they would be buying more. And if we look at the price of petrol, very important in a quote-unquote car-hungry environment, as particularly the U.S. is, that those prices fluctuate by 50 cents. It has a lot to do with quote-unquote dispendable income or the discretionary income of a consumer, which will tell you, if you're looking at it from a down dirty shortcut method, how much discretion is out there. And we've been looking at the whole year how much in terms of salaries, personal income available to people. Salaries, generally speaking, increased about 80 cents. But also, what is the impact of inflation on ordinary people? Well, there's certain things such as foodstuffs have been going up. We don't measure that, but and whereas petrol is going down, is there a trade between the two? Well, somewhat. But at the same time, we look at such things as saving rates. The rate of savings going up, the rate of savings coming down for individual people. In other words, are people spending more than they're saving? The use of credit cards. All this gets into the to macro mix these days, because the Fed uses all of this data to figure out, are they going to be accommodative still, or less accommodative? They decided to be less accommodative, raising the interest rate by 25 basis points. We are now entering a period, and I use the word we, with the various central banks, but particularly in the U.S., a period of less accommodation, and not back to basically where interest rates used to be, because they're at all-time lows. But there was an unprecedented call, at least unprecedented for recent economic history, of the Treasury calling the top bankers in the or top banks and top banking officials and say, well, do you have enough liquidity? In other words, you have enough money in your coffers to survive an economic shock. Now, that is just not done willy-nilly. That is done because of conditions that they see, and many people have highlighted unprecedented developments, in terms of the past 10 years, going back to 2008, the beginning of the Depression, and some other indicators back to the beginning of the Great Depression. What does all of this mean? At this point in time, not as much, but it could, is always a possibility. But what does this mean for the psychology of the market and the broader economy? So that we'll look at from several standpoints here, and we'll look at some numbers. And this is how we will start, summing up what is happening and where we are going. We'll start off here with the Sears, a great brick and mortar store. Used to be Sears Roebuck's. The Roebuck's part of it is in Canada. They separated. Nonetheless, the Sears Holding Corporation, Eddie Lamper here, submitted a $4.4 billion takeover bid for the bankrupt retailer. This is from Reuters, representing its only chance to escape liquidation. That is the path that Toys R Us ended up in, laying off tens of thousands of workers. And a spokesman for the billionaire's hedge fund said on Friday, Lampel, I suppose how you pronounce his name, is backed in part by $1.3 billion in financing from three different financial institutions. Spokesman for his hedge fund, ESL Investments Inc., it would preserve about 425 stores that Sears has yet to close, secure the jobs of up to 50,000 workers out of the 68,000 employed now by Sears. An affiliate Transformer Hodo LLC submitted the bid. People familiar with the matter say financing comes from Sears' existing lenders, the Bank of America City Group, as well as the Royal Bank of Canada, which was not a previous lender. All put together agreed to provide $950 million asset-based loan and $350 million revolving credit line. And some of the bid put forth there, $1.8 billion of Sears debt that ELS already holds and plans to forgive to back the offer. So this is sort of part of normal bankruptcy procedure. The bid would also include $400 million in financing from non-bank lenders, the source said. The bid contemplates assuming protection agreements Sears had previously sold to customers who bought appliances, televisions, lawn tractors, and other big-ticket items. Factoring all the considerations, we believe our ongoing concern bid provides the best path forward for the company, the best option to save thousands of jobs, and is superior for all of Sears' stakeholders. Sears had no comment on this. The U.S. Bankruptcy Court must approve any sale of Sears. The judge would weigh in on the options of other stakeholders. Very important there. Sears is 125 years old, filed for bankruptcy on the 15th of October, developed plans to restructure around the sale of 500 stores and businesses, including Kenmore, Die Hard, the Battery People, the company's home service division, and only Lampel's ESL offered to buy the entire company. The other bids Sears had received were from suitors interested in pieces and liquidation of part. Sears, of course, dates back to the catalog business, and the catalog business is very similar to online business today. Of course, the only difference was you could literally buy a house out of a Sears catalog. Or Montgomery Ward, which is no longer around. and ranging from gramophones to automobiles, house kits, tombstones. It made the Amazon of its time, no doubt about this. But the problem with brick and mortars lost its shine as a consumers, increasingly favored brick and mortar rivals such as Walmart and Target. But Target and Walmart were different. Sears, of course, had a variety of things. Their tools, we bought their tools before. Didn't buy any lawnmowers there. They even tried to sell computers at one time. And in 2005, the Sears Holding was acquired by Sears Roebuck for $11 billion, and combined with the discount chain Kmart, which in our opinion was a mistake. Lamper has pledged to restore Sears to its glorious days when it owned the Sears Tower in Chicago. Used to have an office there. Then the world's tallest building. Companies that included a radio station. They even had Allstate Insurance at that time. And the company stopped turning a profit a long time ago, 2011. After the Depression, it gradually started to sell off assets, including the legendary Craftsman brand and many other properties. They still list Sears Holding, that is, $6.9 billion in assets and $11.3 billion in liabilities. Not a bad mixture there for Sears. Let me just now go to retirees now after the Sears story is enough there. This is also from Reuters. Try to keep cool as stocks tumble. They have a person here named Nancy Farrington. She's a retiree, 75 years old, from the Commonwealth. Admits to being a constant state of anxiety over the biggest stock market rout since Herbert Hoover was president. She has moved from Boston to Charleston, South Carolina. I suppose, I'm not sure why. Anyway, has been conditioned to stand pat and not panic. I hope my advisors are doing the same thing. Well, perhaps not exactly. Retirees are worried about their nest eggs this month. Sell-off rounds out the worst year for the stocks in a decade, going back to 2008, the Depression, the meltdown, and the dot-com crash. Of course, you remember that one, of 2000. Retirees have less time to recover, no doubt, from bad investments than people, say, 20 years younger. I have no way of writing it out if it happens. That's what Framington says. And I can feel the anxiety in my stomach all the time. Well, industrialized companies have generous safety nets. We talked about these here before on our Numbers Man programs. Pensions from the private sector workers largely have been supplemented by these 401ks. We at this mic were not in favor of 401ks when they first became popular, and private savings plans. It means millions of Americans are effectively on their own pension managers. If we point to other countries, Belgium, for instance, Canada, Germany, France, these all industrialized capitalist countries, Italy, receive on the average about 65% of their income replaced by mandatory pensions. In the Netherlands, the ratio of benefits to lifetime average earnings is about 97%. That's according to the Organization for Economic Cooperation and Development report. It compares the U.S. replacement rate for Social Security benefits is about 50% or less. U.S. retirees have watched their private accounts mushroom during the bull market when the market was up, but the bears have come back. Now, that market came after the Depression, which is not unusual, 2009. And the Feds kept rates low, near zero. So thus, retirees went into stocks, got out of bonds. The certificate of deposits used to be, Mr. Nader has talked about this. When the interest rates are low, those are not good investments. Now interest rates are going up again. They become a little bit more attractive. Still fewer have gone all out on stocks in recent years. Just 19% had more than 80% of their 401ks invested in stocks in 2016, down from 30% at the end of 2007 before the Depression. That's according to a non-profit research group called EBRI. Nothing has gone wrong, but it seems the market is trying to figure out what to do wrong. It's Brooke McMurray. He is a New Yorker, 68 years old. He's a retiree who says she's become a financial junkie after the 2007-2009 Depression, which they call a financial crisis. Three major stock indexes have tumbled about 10%. And also the tariffs, the situation with China. Cooling economy and rising interest rates are on track for their worst December since 1931. That was a depression. The S&P 500 is for its worst annual performance since the depression, when Wall Street buckled during the subprime rate there. We had a lousy forecast in 2008. That is from someone named John Baer. He worked for McDonnell Douglas and Boyne for 36 years in St. Louis. Today, employment is way up in the housing market, and we'll get to that in a minute. Is steady and corporations are flush with cash, but that cash is not flying out here. Now, this is the event we mentioned a few minutes ago. This is Secretary Mnuchin. Call to top bankers did more to rattle than assure markets. The markets tumbled 2% the day before Santa Claus rode in. That was Christmas Day. Needless to bear, prepared to ride out the market. Well, suppose so. Anyway, there are some factors helping take the sting out of the market rout. That's from Larry Glazner, managing partner at Mayflower Advisors in Boston. Retirees are sensitive to energy prices. We saw a big decline before the holidays. That's good for the broader economy, and there's nothing more than, again, psychologically supportive than cheap energy prices. Well, you have cheap energy prices, but at the same time, you have to look at other things. There, oil prices are hovering around 18-month low after some volatility. And I'll finish that up. Well, that is one of the big things going on here. And if we look at actual pricing, a 2-year low, basically after near 40% decline this quarter. This is West Texas crude. We always give this is now at $45.33 a barrel. So they go there. And a list of other things here. Breaking with the bad news: the Chicago Purchasing Manager Index came in ahead of consensus. That is Chris Bailey at Raymond James said the dollar's weakness was good news for non-U.S. assets. Well, yeah, no. Gold is purchased at 6 months high at $1,280.11. It's basically a roundup. The dollar index dipped 0.14 with the euro up 0.14. It's basically at $1.14, and the yen is also strengthening there. But efforts at a late Santa Claus rally failed to entice investors. There, the global MSCI index, the Standard & Poor's and Dow, and NASDAQ are each headed for their worst year since the Depression, 2008. The index of global equities gained 0.57% to bring the global benchmark to a weekly advance of of 22 cents. The Dow was down. It was on Friday, I suppose. I look at this article here. 76.42 or 0.33% to 23,024.4. The S&P 500 lost 3.09 points, are 0.12%, 2,485.24. The Nasdaq added, 5.03 or 5.3 or 0.8%. And this is the summary, as I said, on the 28th. So again, I finish up there, and we look at energy today. This is from the U.S. Energy Information Agency. U.S. coal consumption in 2018 expected to be the lowest in 39 years. So much for the coal strategy here, and we read more of this. The Energy Information Agency expects total U.S. consumption in 2018 to fall to 691 million short tons, a decline of 4% from 2017, the lowest since 1979. U.S. coal consumption has been falling since its peak in 2007. That's before the Depression. The forecast that 2018 coal consumption would be 437 MMF is 44% lower than in 2007 levels, and is driven by decades of coal use in the electrical power sector. The electrical power sector is the nation's largest consumer of coal, accounting for 93% of total coal consumption between 2007 and 2018. Decline of coal consumption since 2007 is the result of the retirement of coal-fired plants and a decrease in the carbon factor, or the utilization of coal plants, as an increased competition from natural gas and from renewable solar energy, in particular in places like California. In 2017, coal-fired capacity in the U.S. totaled 313 gigawatts across 147 generators, 1,470 generators, and by the end it was 529 of those generators with a capacity of 55 gigawatts had been retired so far in 2018. 11 gigawatts of coal fired the months of year based on data reported to them. And one relatively small new coal-fired plant with a capacity of 17 megawatts is expected to come online by the end of 2019. Decline in coal-fired capacity is expected to further reduce coal consumption. Now, this is interesting in terms of U.S. energy policy, particularly the Trump administration trying to revive coal. Well, it's not going to happen there. Environmental concerns have also played a role in coal retirement. Coal retirements were the highest in 2015, given it's part of a strict emissions policy required by mercury. Now, there was a situation that the Energy Department would allow more mercury there. Air toxic standards, rules of emissions, period. And you can expect more of this to come in the future. this administration will lax things, but things that were laxed will turn around. We have some data here from the National Association of Realtors. This is again, we are still with Reuters here. We're back to Reuters, I should say. The Wall Street rally paused, but stocks meant weekly gains. This is was published on the 28th. We just extract some out here. It started off with worries over the Christmas Eve drop. The market has seemed to be forming a tradable bottom. That is from State Street Global Advisors in Boston, Michael Aroni. Anyway, in the last few days, even including today, you're seeing investors come in and starting to look for bargains. Well, bargain hunters, you're going to have, no doubt, up and down concerns. Of course, over China is still investors are beginning to price in the factor that they believe the Fed will raise interest rates much more slowly in 2019. A lot of that will depend on where inflation is. Incidentally, let's jump back just a minute to inflation in the Russian Federation hit 4.2. We covered on BR on the World. That is our international program, the year-end news conference of Vladimir Putin. We recommend that you listen to some of his address. But nonetheless, the Russian Consumer Price Index, PCI, rose slightly above their central bank target, and it was at 4%, 4.2%. For an economy like the Russian Federation, that is not bad at all, period. Annual inflation December accelerated to 4.2%, exceeding the central bank's 4% for the first time since 2017. Over the month, inflation picked up 0.8% in December from 0.5% in November. So that's the Russian banks. Let me jump back again here. Some idea of where they are. In China, inflation is under control thanks to a number of things, drops there in the economy. And let me move on from Reuters here. Uh-oh. To Goldman Sachs, it cut the growth forecast for the first half. That would be what Q1, Q2 of 2017, citing a need to land the plane without a recession. They shaved their growth down, and we'll get to it in just a second here, and we will append it to this broadcast next year from 2.4 to 2%. And said growth would slow to a virtual crawl below 2% in the second half. Needlessly, the bank declared it was still not particularly worried about a recession. Well, again, to look at this a little bit different, volatile financial markets and soft economy. Incidentally, we had not mentioned as of yet the shutdown, which is in its second week. There will be no resolution yet, obviously, to next year, 2019. Throw that in very quick here. It's trimmed its expectation. This is Goldman Sachs. This is on Saturday. The caution that a full-blown recession was not in the cards. Well, we at Cranston Analytics see a full-blown recession, and that is a lot of play on words, which the author Rick Stout, the Nero Wolf Mysteries, would call it quibbling. Well, you have a quote-unquote official definition of a recession. What a recession is: 3/4 of virtually no growth at all. Or you have modern definitions that we saw in 2008. They called it a Great Recession. We call it a depression. And in Europe and various other places, London, etc., they call it also depression. So we'll call it depression. Whereas in 32, they called it the Great Depression. So you've had recessions, you've had severe recessions, but that was not 2008. 2008 was a depression, and it took 2 years. It took 10 years to pull out of it, basically speaking. And 8 of those years were under Barack Obama. Now that you consider that the last 2 years the economy has been supercharged, or juiced, or what do you want to call it? It's not a very good economic term. But with a 1.5 trillion tax cut, throwing it in there, and also at the same time, much of this money under the so-called trickle-down theory didn't trickle down. Corporations took the money and bought back, I should say, buybacks of their own stock. And the repatriation part of it just didn't happen. There was some repatriation of money that is in Irish banks that are in various havens, and it's still there. So that part of it is a little bit different. Yes, you had some gains in terms of compensation, wages, etc. The super store on the web, Amazon, raised their workers to $15 an hour, which in some markets they're already over $15 an hour. They're more like $17 or $18. That's starting. And you had, of course, Walmart earlier raising their workers to at least $10 an hour because they couldn't find any workers. So you see in that part of it, the Target Corporation, etc., the other online brick and mortar stores. In fact, there was one, we throw this in, an analyst predicted that Amazon would buy Target. And the reason for that, they would have more brick and mortar locations to compete with Walmart and some of the other that are left brick and mortar locations. The problem there is, if you look at the circumference, the retail circumference, it is really not expanding, not in the U.S. There's Toys R Us, when it was liquidated, the other merchandisers there, whether it be Walmart, Best Buy, etc., just took up a percentage of the toy market, what was left of it, and moved on. So you see some probability there. Back to this is from CNBC. Volatile financial markets and soft economy data have led to trim. We just talked about the trim. We're going to get to the whole thing in a minute here. And they went on to say, this is Goldman Sachs, they were not worried particularly worried about a recession. Well, in view of a growth slowdown, it's necessary to land the plane. This used to be called, incidentally, a soft landing. The two historical risk factors, inflationary overheating and asset market bubbles, remain largely absent. Well, the reason you're not having overheating is because you've been raising the interest rate by 25 basis points, and it's went up now, about 3%, to about 3%. We now see problematic, the weighted, 1.2% hikes in all of 2017 from a 1.6 hike previously. Needlessly, our forecast remains about market pricing, which implies a stable funds rate in 2019 and perhaps cuts in 2020. That means 2020 is will be more distressed, or 2020. Why did I say 2020? Anyway, the bank isn't alone in thinking reversal of Fed policy could be in the making, especially with head spin volatility driving stocks into correction territory. History has shown the Fed can and will change its mind on a dime. And they go on to talk about an analysis written by David Rosenberg, the chief economist and strategy at Gluskill Shelf. Anyway, when I tell people that the Fed will be easing monetary policy in the coming months, the view is met with laughter. but it's not a laughing matter. He told clients, this is Rosenberg, these folks who sneer and shake their heads just because of what the central bank is saying are not students of history. Well, no doubt about that. The Fed has retreated before there, and this is Mr. Jarvis David. He's a senior editor at CNBC. The good news for the economy remains is a solid employment market and contains price pressure. The bank added, Goldman expects the unemployment rate to continue downward, hitting 3.25% by the end of 2019. Tighter labor markets and tariffs from China battle will result in modestly higher inflation, and they expect core prices to move to 2.1%. We expect it to move higher than that. Now, I believe we, let's see. Oh. This is by Don't Laugh, the Fed will cut rates in the coming months. That is David Rosenberg there. History, we won't go over that, but the Fed is committed to a steady but gradual pattern of rate hikes. Of course, that was from the Open Market Committee. Nothing new there. But what it does mean, if the Fed decides to cut rates in 2019, say, for instance, in Q3, Q4, that means the economy is in trouble. They have to move back to accommodative period. Rosenberg is among a small group of Wall Street experts who think not only is the Fed done hiking, but it's also will soon be cutting. Well, that in itself is a show for, a thing for concern, citing multiple instances in 1995, Rosenberg said the Fed has gone from raising rates to lowering rates in a period of a few months. He points to March to July period 1995. It's a different economy, though, however. The June-September span in 1998 and November 2000 to November 2001, finally the whirlwind events around the financial crisis when the Fed went from worrying about inflation, that was in 2007, to a dramatic 50 basis points. Well, the problem there was you were entering a depression. The 2007 rate slash began an unprecedented round of easing that saw the federal benchmark rate cut to near zero, R0, embarking on 3 rounds of asset purchases. That was called quantitative easing, ballooning its balance sheet to $4.5 trillion during that period. And this is one of the things that central banks can and will do. But its effect over the broader economy is a little bit different. That's life support, it's called. The about face, especially from the summer of 2007 to the fall of that year, as well as the fact that the Fed had switched to a tightening basis in the summer of 2008, then eased the policy. Well, they had to ease the policy, had moved into a depression. Traders in federal funds future market are indicating just 13.5% chance out to January to 2020, according to the CME tracker. In fact, the market is pricing in a 25.3% chance of a rate cut by then. The current fund rate is targeted range and between 2.25% and 2.5%. That's the target range there. Now let's go to the actual. Oops, where are we? Go to the actual Goldman report. We'll append this on the outlook, the home stretch 2019, and just 1 second here. we'll hit the highlights. We obviously won't attempt to hit everything here. We'll put this PDF on. The U.S. economy growth is expected to slow from 2.9% to 2.5% in 2019 due to tighter financial conditions, fading fiscal stimulus. According to Goldman Sachs, the forecast calls for multiple rate hikes as the Fed looks to keep the economy from overheating, rising inflation, unemployment on a downward trajectory towards 3% by early 2020. There are a lot of things that play into that particular situation to Goldman Sachs. Oh, we had this already up here. Now, here we go. Anyway, not for nothing has the Fed chairman, this is Lawrence Powell, we're just starting it out here, extraordinary times the U.S. economy enjoyed in 2018, and the growth is expected to exceed 3%. The unemployment rate is a 48-year low, and inflation is right on target as we look to 2019. And natural question is how long the good times can last. Growth is likely to slow significantly next year. This is not unusual when you have growth that exceeds what would normally happen in the case of the U.S. A modern capitalist economy. Recent pace of 3.5% to roughly our 1% estimate potential by the end of 2019. This is quite a drop. We expect tightening financial conditions, fading a stimulus to be the key drivers of deceleration. Robust job creation should push the unemployment rate to 3% by 2020, well below the 4.5% of full employment. Well, 4.5% to 5%, and in some terms, 4.5% to 5%, and in some instances, even 5.5% have been called full employment, depending on whom you're talking with. The rate consistent with 2% inflation. Inflation is over 2%. Wage growth should reach 3.25% to 3.5% in this environment. From a wage pressure coupled with additional tariff rounds should boost core PCE inflation to 2.25 point by the end of 2019. Let me just up this just a little bit here and make sure that okay, we had that right. While Fed officials are comfortable with this inflation at this level, well, 2.25 points is not a bad inflation level. Is likely to raise rates in December, and we expect 4 more hikes. This is what they from Goldman. That has already been done. They expect 4 more hikes in 2019 to bring the rate somewhere between 3.25 to 3.5%. About 2 hikes above the market forward, with a large overshoot of its labor market tightening on the way. The FOIC, that's the open market, will likely be reluctant to stop until it's confident that the unemployment rate is no longer on a downward trajectory, a point we expect to reach in early 2020. A lot of this is also brought on, incidentally, by retirements. They talk about that one. History counsels that large labor market overshoots raise recession risks down the road. While we take the lesson seriously, we think it's being applied too mechanically in markets today. A flattening and more anchored Phillips curve, it comes in here. We haven't talked about the old Phillips curve lately, but should allow the Fed to unwind the overshot more gradually, given its a good chance of beating the historic odds. Well, if the Fed beats the historic odds, the only reason it will beat the historic odds are because of financial rules that are brought about by Dodd-Frank. On the monetary front, the Fed appears very likely to deliver the fourth rate hike. Well, that's already happened, following four tightenings actions in 2017, but in contrast, 17-18, the Fed's actions were matched by a larger tightening in broad financial conditions. We're winding this down here. The financial outlook for 2019, less growth, more inflation. And that is the primary reason for the 25 basis points raise. A number of things. We've looked at this from Dr. Reich out at Berkeley. And there's some mismatches here. Hopefully we can still find that quote here before we leave. The slowdown should come gradually with, and this is one of the things you can never predict. Will you have a gradual slowdown, or will the slowdown be much more rapid? As what happened in the last depression. Well, it can be very rapid because the conditions can always be there, and this is one of the big problems you have when you're talking about fiscal monetary policy, but also relying on quote unquote stock market and the commodity markets, which commodity market is highly speculative, and the market itself. When you have buybacks, these types of machinations going on, stock prices can in fact go up because the company is buying back its own stock, which boosts its power. But at the same time, when you look at market conditions such as iPhones, etc., those you have to look at. We expect consumer consumption growth at about 2.5% in 2019. With further acceleration of tension with China likely, we find this is probably what you're going to have as long as this administration is in power. And a lot of this is for various other reasons also. Anyway, with growth likely to remain above the potential a whole while longer, the impressive recent momentum of job creation is likely to fade only gradually. Monthly payroll growth has averaged 215,000 over the last 6 months. Our statistical model suggests that it is likely to slow to about 90,000 break-even point. 90,000 break-even point needs to the rate stabilize until 2020. By then, we expect the unemployment rate to decline to 3%, well below the 4.5. We talked about that. Let me just move through this a bit here. Core PCI is likely to grind higher next year, while the recent inflation readings have been soft. We expect to reach, we already talked about this, 2.25%. And since we're going to pinch this, we're not really beating historical odds. The recession risks in 2019 and beyond, we take seriously. Again, you have to look at this summary here from Goldman Sachs analysis as statistical analysis. At the same time, it is an analysis that's not completely objective. It is subjective. The obvious recession risk beyond 2019 is mundane and a technical one. With low growth potential rates and possibly need to operate the economy a touch below potential. Now, this is a little bit different. This is one of the reasons you can save yourself from a severe hard landing by slowing your economy down. Virtually, we forecast 1.5 growth in 2020 and 2021. This is slowing the economy down. And as you slow the economy down, your wages and various other things could start to stagnate. And let me just take a quick look at this and we'll conclude this. I just need to make it. Okay. Now, this is real GDP. We look at it in terms of 2016, 1.6. 2017, 1.2, 2018, where we still are for a few days, 2.9, 2019, 2.5, and 2020 at 1.6, 2021, 1.5, 1.7, 2022. And this is across state and local governments at 2. That was in 16. And a drop to negative 0.5 in 217, and in 218 at 1.2, 1.8 in 219. So state and local governments expenditures will be a little bit more. And in 2020, let's see, where are we? 0.4 tenths in 2020, and nothing there. Housing starts, and we need to get to housing, so we'll kind of move along here a little bit. At 1,177,000, that was in 216. Oops. And we're at 1,278,000 in 18, and a drop to 1,314,000. We'll conclude this in just a pinch because we'll move on. We're now at the National Association of Realtors. Pending home sales slipped in November, but saw a minor increase in the Northwest and West. That's according to the National Association of Realtors. The pending home sale index, a forward-looking indicator, decreased 0.7% to 101.4 in November, down from 102 in October. Mr. Lawrence Yang, he's the Dr. Yang is the chief economist. The current sales numbers don't fully take into account other data. The latest decline in contract signing implies a more short-term pullback in the housing sector and does not yet capture the impact of recent favorable conditions of mortgage rates. Young added that while pending contracts have reached their lowest since 2014, all major regions sustained a drop when compared to 1 year in the past. Let me just play a little bit of this. I think I can play a little. I'm going to try.
Hello, I'm Quentin Simmons, the Economic Issues Media Manager here at National Association of Realtors, and I'm with our Chief Economist, Lawrence Young. Lawrence, pending contracts have hit an all-time low since June 2014. Should we be concerned that this is the beginning of a very long downturn?
Right now, I would say over the short term, it is uncertain whether there will be a continuing decline. The latest month is another 1% decline, or slightly less than 1%, but it is down 7% from 1 year ago. So these are a sizable decline from a year ago. And also this reflects the rising interest rate that occurred in the second half of the year. Now, in the last couple of months of the year, we have seen mortgage rate retreat, but the consumer behavior of signing contract will not show up until upcoming months. So it will be interesting to see. But this downward trend in pending contracts is still reflecting higher mortgage rates.
You say the West region is all drama at the moment. How do you see buyers returning to high-cost places like Seattle, San Francisco, and Los Angeles?
The West Coast, very expensive. So even as people are finding jobs, and the job market is very strong in the West region, but they just simply cannot buy a home. Prices have risen just too much, too fast. And as a result, the latest pending contract in the West region is down sizably, 12%. And we also saw that in closings, it was down 15%. So the drama, big swings are occurring in the West region. So there has to be more affordable home availability inventory. And the builders will say, well, the land cost is expensive. The zoning regulation is too stringent. Therefore, some local officials really need to consider about how to boost local supply. Otherwise, they may see population out-migrating into nearby states and away from the West Coast. So affordability challenges out in the West.
As you know, we have a government shutdown. What do you think the impact of that will be on the economy and on the real estate market?
Well, Quentin, you and I are working here in Washington, but many people in Washington are not. It's government shutdown. And very disappointingly, the flood insurance has not been available during the government shutdown. So this is unlike past shutdown when flood insurance was available, which means that roughly 40,000 homes may not get transacted because it requires flood insurance in order to get mortgage, and most people need mortgage to buy a home. So about 40,000 per month lower transaction during if the government shutdown was to be prolonged, and then consequently also the economy. Anytime there's a government shutdown, consumer confidence may be dampened. So even if they have the cash, they may not spend money, and that will hold back economic growth. So it's a bad news all around. I hope people in Washington just compromise and get the government up and running so that flood insurance is available, because realtors, they're working every day, but with the shutdown, it's holding back economic growth.
Let's now turn to forecast. What do you think the mortgage rates will be this time next year, and the total number of homes sold in 2019?
Now, one good news out of the stock market volatility and also more discussion about possibility of a recession. Now, I don't foresee a recession in 2019. There are some risks, like trade war could trigger into a recession, Federal Reserve becoming too aggressive also may be a hindrance. But my best guess is that there is sufficient momentum in the economy. We will not face recession. But the stock market volatility has led to the interest rates actually falling. I mean, this is independent of the Federal Reserve. It's about the bond market investors. So the mortgage rate have retreated in the past couple of months. So there could be some second chance opportunity for people who stepped away with lower rates. So spring buying season will be very interesting. Right now, I have the forecast for home sales in 2019 at 5.3 million for the annual total, which would be essentially equivalent to in 2018. But the mortgage rates rising much slowly, 5.2% in 2019 compared to what I had anticipated earlier for a little higher, so a little more attractive mortgage rate condition.
Well, that's not unusual. That was Dr. Young there, and let's move on here. Uh-oh. The Federal Reserve senior financial officers survey basically uses survey to collect and gather quantitative and limited quantitative information about liability management, the provisions of financial services, and the function of key markets. And this is the number of respondents. Frequency is 4 times a year. This is the update, and let me just a minute here. Latest. And the numbers, and this, I believe, is in November. Wait a minute here. November 29th is the latest one. This is their summary. This is reported in Reuters, and I think we have the right one here. And this is more what the panel was than not what we wanted here. We may have to, and for whatever reason, we're not getting it. Well, I'm still stuck here. This would be the September one. I don't think this is what we want. We want the November one here. And we'll just have to skip this one. We move on. The conference board. Anyway, nonetheless, the conference board's index decreased in November following a modest decline in November. The index now stands at 128.1, down from 136.4 in November. The preset situation index, based on a consumer's assessment of current business and labor market conditions, declined slightly from 172.7 to 171.6. The expectation index, based on consumers' short-term outlook for income, business, and labor conditions, decreased from 112.3 last month to 99.1 this month. The monthly consumer confidence is based on probability design random sample. Is conducted by the conference board for the conference board by Nielsen. Nielsen appears here once more. Consumer assessment of current conditions declined slightly in December. The percentage of consumers saying business conditions are good decreased from 42% to 37.2%, while those claiming business conditions are bad increased from 10.7% to 11.3%. Those claiming jobs are plentiful decreased marginally from 46.8% to 46.2%, while those claiming jobs are hard to get declined from 12.6% to 11.16%. That's a 1%. Their consumer optimism about the short term fell in December. The percentage of consumers expecting business conditions will improve over the next 6 months decreased from 21.9% to 18.3%, while those expecting business conditions will worsen increased from 8.3% to 9.7%. And this is the conference board. So we move on here. Now we'll look at the markets and where the markets are. Some of the various that we're into Asia now. This is incidentally from Reuters. The Hong Kong index at 1.05. The Nikkei down 62.85. The Hang Seng at 25.31. The all ordinary index ASX at 53.9. The Korean index, we don't usually give this, but anyway, it's at 12.60. In Jakarta, we've not done that before, at 3.866. In the Philippines, the stock exchange there at negative 16.64. Somebody in Shanghai at 10.81. And the Asian Pacific, Russian index, we haven't given this one before either, at 0.94. The Australian index at 2.60. Malaysia, where's Malaysia? At 0.54. In New Zealand, they're at 0.21. Pakistan, negative 14.42. In Singapore at a 0.63, and in Vietnam negative 1.80. And let's go to the Middle East and Africa. These are some we haven't given in that last show. This is the TR Equity African Index at 5.27. In South Africa, that index is TR index at 11.67. Egypt at 3.94. Israel at a negative 0.51. Kuwait at 0.30. Morocco at a negative 0.66. Oman at 0.84. The UAE, let me get them right anyway, at 0.64. Bahrain at 3.90. In it's another Cairo index here at 144.5. Kuwait at nothing there. And that's pretty much it. We'll go to Europe. The FTSE 100, we always get a FTSE 100 at 149.29. The DAC at 177.45. The CALC, that's in France, at 80.13. The Swiss Market Index, I haven't given that one, at 233.66. I think we'll use this from now on in Madrid. They're at 13.29. In Stockholm, this is the OMX, all shares at 9.80. In Helsinki, that's the Finnish one, at 115.64. In Copenhagen at 12.86. In Norway at 17.83 there. In Amsterdam, we do give Amsterdam, is at 8.14. And this is another one in Spain at 129.80. In Denmark, that index is at 6.75. In Greece, 0.03 there. TR Sweden index at 4.57. And in Poland, they're at 2.84. Let's go to the Americas now. Very good one here. We'll start at the bottom and work our way up, so to speak here. Well, maybe we won't. The Dow, nonetheless, was down 76.42. It's been going down. The NASDAQ Composite at 5.03. And let's see. In Canada, this is Equity TR Equity Index at 1.19 is one of the indexes here. And let's see, go to the U.S. itself. I've not used this index in its entirety, so we'll have to look and see what we are stuck with here, so to speak. See if we somehow get our commodities going here. We're always looking for the infamous pork bellies. Nonetheless, Brent crude, this is New York, sorry about that, this is at $42.12. Brent crude, the ICE is at $53.21. You can kind of see that. Dubai, we haven't given this one. Dubai spot is down 55 cents at $50.68 US. This is energy. Let's get to agriculture here. Commodities futures, incidentally, is what we're dealing with here. We hope. Store for us, wheat is up 0.75. Corn up actually 50 cents. I guess we'll just do it that way. Canadian canola oil here is down 10 cents. And U.S. coffee down 75 cents. Cotton is up 20 cents. And cocoa, we always look at it, it's up $25. So these are some of the agricultural type of commodities here. Winter wheat or just wheat? I don't know if we have winter wheat or not. It's up 50 cents. Anyway, to livestock. Here we go. Live cattle is up $1.27. Live hogs, I guess the best we can do is up 20 cents. Pork bellies, that's for delivery on February 19th. And live cattle is up 25 cents. This is February 19th. December 18th. Not sure what that one is supposed to be. But basically that is where we are. The bond market, the 10-year, and nothing there on those yields. So this will do it for us. Learn a little over, but not too much over. Wish everyone a happy New Year 2019. Happy Kwanzaa. Happy Christmas in case we missed anyone. Well, I guess we've done all the holidays here. Well, also happy Hanukkah. We got everyone. Nonetheless, for those in business, make next week a short week, a productive one for the consumer. Evidently, you've kept your eyes on the prize. Watch the interest rates, as Professor Reich would say. Watch your wallet, because things are definitely changing out there. There's no doubt about that. And I was seeing if I could find him, and we didn't find his final words to the consumer. I guess not. Anyway, the in and outs of it was that, we haven't. Was that the interest rate has, of course, positive and negative implications. There's no doubt about that. There always is. And we always look to that. Came at a bad time in terms of jobs. Well, let me see here. Yeah, here we go. Dr. Reich. You look long enough, you find everything. He said the problem with the Fed's hike is now that Trump has stressed the paychecks of most Americans. The rate hike will make matters worse. Most Americans have jobs, but their pay has barely risen when adjusted for inflation. That's very important. And added the burden on them, undermining the Affordable Care Act, or what's called Obamacare. Rolling back overtime pay, very, very important. We've touched on this in one of our broadcasts. Hobbling labor organizations, reducing taxes on corporations and the wealthy, but not most workers. Allowing states to cut Medicaid, very important there. And imposing tariffs that increase the price of goods on ordinary people. I added the ordinary people, which suggests we are careering towards a soft crash. We had in 2018, and possibly as bad as 229. That's Robert Reich. He was at one time the Treasury Secretary under Bill Clinton. The underlying problem isn't that Americans haven't been living beyond their means, is that their means haven't been keeping up with the growing economy. Most gains have gone to the top, and the majority of households take home a larger share of the national income. They shouldn't have needed to go so deep into debt. Without wage growth, most American workers can't continue to buy. They are in the same sort of debt trap that preceded the Depression of 2018 and the crash of 1929. By quarter of this year, first quarter of this year, household debt was at a high record of $13.2 trillion. The last time household debt was nearly this high was before the Depression. He called it Great Recession. Similarly, between 1913 and 1929, the ratio of personal debt to national income nearly double. The Fed hike will only make things worse 10 years after the start of the Great Recession. We call it Depression. It's important to understand the roots of the collapse. It wasn't a banking crisis. It was a growing imbalance between consumer spending and total output brought on by stagnant wages and widening inequality. The imbalance is back. Watch your wallets. That's Professor Robert Reich. He is a professor of economics at the University of California, Berkeley. You can find him on Facebook, and if you go to Cranston Analytics Facebook page, you will find him there, and also at our Cranston Salt web page. This does it for us on the 29th of December, 2018. This is Numbers Man from the Jerry Pippin broadcast booth, and we'll just close out here. Incidentally, we appreciate the partnership of Cranston Analytics and the many other people named here that we cited. And hopefully we've cited Reuters, CNBC for their reports during the year, the BBC, their economic contributions, and anyone else, particularly the Federal Reserve, the Bureau of Economic Analysis. Incidentally, they are on a furlough also, so we won't be getting any reports from them until the government reopens.